This paper examines the capital, liquidity, and profitability of the world's 20 largest banks before the 2008 global financial crisis and before the COVID-19 pandemic. And the analysis was done as of March 2020. So there are several similarities and differences between the two crises. So before we look at the analysis, it is useful to examine the similarities and differences. So first, the similarities. Both crises were accompanied by a significant amount of uncertainty as to the future impact of the crisis. And we measure this by the GPU index. The GPU index looks at newspaper coverage, disagreements among economic forecasters, and many other variables to measure uncertainty. So you can see that during the 2008 financial crisis, the GEPU index reached a peak of about 200 points, and the uncertainty index at the beginning of the pandemic or around March of 2020 is more than double at 433. So it looks like there is significantly more uncertainty about the future than with the global financial crisis, although what is similar is that both events are associated with significant economic uncertainty. We can see this volatility even in the stock market, and this it's very comparable. The volatility during the global financial crisis and during COVID-19. Although, as we know, the stock market, the world stock market indices have performed very well during the COVID-19 pandemic, which is kind of interesting and surprising. But there is significant volatility in the market during both of the crises. Also, both of the crises were accompanied by global recessions. Although the recession accompanying the COVID-19 pandemic is expected to be far deeper than the recession that we experienced during the 2008 financial crisis. You can see the dip being deeper for the COVID-19. Not surprisingly, if you look at the individual countries' GDP growth rate, we should expect countries that have controlled the pandemic more effectively, like China, Singapore, Korea, Taiwan, etc., would do better. Both of the financial crises were followed by significant unemployment rates. You can see in the 2008, it reached a peak of 8%, and economists expect, at the IMF, expect the unemployment rate due to the COVID-19 pandemic to be as high or even higher. Again, remember that this is as of March 2020. There are a lot of similarities in the way the central banks have reacted to the two crises. The main goals in both of the crises were to cushion the inevitable and significant drop in the economic activity. In the case of the 2008 financial crisis, it was due to the freezing of the financial markets. And in the case of COVID-19, it is due to the lockdowns and other containment measures. So the actions of the central banks have been very similar for both of the crises. It's the lowering of interest rates to lower funding costs. It is expanding short-term and long-term lending operation to address liquidity issues, quantitative easing, which is essentially where the central bank prints money and uses that money to purchase private and public assets in order to increase the money supply, lower interest rates, and encourage lending and investments. And other actions such as relaxing bank capital requirements, creating repo facilities for short-term borrowing, etc. In terms of the differences, the cause of the 2008 global financial crisis was endogenous. It originated in the banking sector and then spread to the rest of the economy. So everyone knows the story of the 2008 financial crisis, but it's worth repeating here. So essentially, in summary, subprime loans were granted to households with inadequate income and assets. This drove up the demand for homes and as a result drove up home prices, which led to homeowners further borrowing money against the increasing equity in their homes. The toxic risk associated with these loans were hidden through the process of securitization, in which the subprime loans were bundled together and securitized into new financial vehicles such as mortgage-backed securities. So and of course we know that the rating agencies gave these mortgage-backed securities AAA rating. However, as the homeowners defaulted on their loans, the housing bubble burst, home prices tumbled, and the securitized instruments, most of which were held by banks, became worthless. So banks at this time were very heavily leveraged, and they were unable to withstand the mounting losses and began to fail. And this massive liquidity crisis then turned into the 2008 global recession. So the shock essentially was endogenous, it was within the system, whereas in the case of the COVID-19 crisis, the shock is exogenous. It's outside the financial system. It's the coronavirus pandemic. And the economic downturn due to the pandemic, in turn, is putting a strain on the global banking system. So the shock is external to the banking system. So in the case of the COVID-19 pandemic, in an effort to contain the pandemic, draconian containment measures have been implemented, like lockdowns, social distancing, transportation restrictions, and this has led to the shutting down of large sectors of the global economy. And this has significantly negatively impacted the demand side of the economy. Now, because of global supply chain disruptions, this has negatively affected the supply side of the economy as well, but not as much as the demand side. Because of the economic downturn, households and businesses will be unable to meet their financial obligations, default on their loans, put downward pressure on bank loans, investments, and other derivative portfolios. In addition, the low interest rate will negatively affect banks' profitability. So this is, in the case of the COVID-19, the shock is external, and that is through the economy affecting the bank's balance sheet and the income statement. The other difference is, as I mentioned before, is the way the stock market reacted to the two crises. So here you can see this is the MSCI World Index. And here you can see in the 2008 crisis, there was a huge drop in the stock market indices. And it took about 3 to 4 years for it to recover to the levels it was before the crisis. But if you look at the COVID-19 impact on the stock market, you'll see there was a huge drop in February and March of 2020. But since then, the market has not only recovered, but broken through what was the previous highs. And that is kind of very different from the way the stock market reacted to the 2008 financial crisis.